Overall, the next financial year, as we stand here, barring any global uncertainty, looks like a very promising year. Markets are inherently volatile, right? And volatility is not bad.
Welcome to Geojit Spotlight. Today we are privileged to have with us Mr. Gopinathan Natarajan, the CEO of Asset Management at Geojit. In this conversation, we aim to explore his perspectives on the global and Indian economy, delve into the evolving trends in the alternative investment fund industry, and gain valuable insights into portfolio management strategies tailored for diverse investor needs. Welcome, sir. Welcome to Geojit Spotlight.
Thank you, Abhilash. Thank you for having me on Geojit Spotlight.
So, what are your overall expectations for the global and Indian economy in 2025?
Before we get to 2025, that means the FY 2026, what we need to also understand, where we are coming from, right, and where we are. That's very important because that sets a context, right? In the last 3 to 4 years, our Indian markets have had a stellar performance, largely led by 20 plus percentage compounded growth of corporate earnings, and also fueled by domestic liquidity, household money, savings coming into stock markets via mutual funds, PMSs, HNIs, retail, all that, right? The year 2024 has been a year of consolidation. We've had two large events, both domestic as well as global, which is Indian elections as well as the US election, which markets have reacted to. And we've also seen some geopolitical, tensions continue to simmer. And this has been a year of both earnings as well as market consolidation. And with some of these events now behind us, and India now looking at, both our monsoon agri crop as well as the upcoming Rabi winter crop also looking very promising. Looks like could be a bumper agriculture output. And plus the fact that going forward, we may see, government coming in and, whatever pent up spending which did not happen thanks to elections could happen in the next few quarters. And we could possibly see a revival of a cyclical, consumption downtrend that we've seen in the last few months. All of this, plus the fact that, the big global political uncertainty, which is US election, that's also now off the table. We could see a return of maybe a 16, 17, 18% kind of corporate earnings growth in the next financial year. And this augurs very, very well for Indian stock markets as well as investors who are either looking to put money now or who already have put money and wanting to stay invested. So overall, the next financial year, as we stand here, barring any global uncertainty, looks like a very promising year.
So, how do you perceive the current market trends, and what role does portfolio management play in helping investors navigate market volatility?
It's a good question because markets are inherently volatile, right? And volatility is not bad, right? In fact, portfolio managers like us and portfolio management services general, which look at investing over a very long-term period and look at picking stocks and sectors from a very long-term perspective, actually make use of such volatility to actually buy into companies at a much cheaper price than what would have been possible when the markets were at an all-time high. So for us, volatility is our friend. And for investors who are seeking to invest and create wealth over a very long-term period, services like portfolio management service, PMS, is could absolutely be central to their allocation. And it will continue to add significant value to investors who are seeking to generate, sustainable long-term returns and wealth creation.
So, how do you tailor portfolio management strategies to suit the diverse needs of investors, and what advice would you give to the new investors?
So, if someone is new to Indian capital markets for investment and who has investable surplus of 50 lakh rupees, and who is looking to invest for a very long term, I think portfolio management service is a great first step, because it caters to, if you're a new investor, I'm assuming a new investor would be uh, possibly resource starved or time starved, or even knowledge deficient to an extent, right? May not know the know-how of long-term investment, which stocks to pick, which sectors to invest in, right? And may not have the resources to do research and long-term research and stuff like that. So portfolio management service is a very, very ideal choice. And if you are a long-term investor, if you're a new investor, and if you have say 50 lakhs of money to invest, I think PMS is possibly a great choice for you. In terms of tailor making and suiting the needs of investors, at Geojit, if you look at, we have a variety of schemes. We have a freedom portfolio, which invests largely in large cap companies. We have a advantage portfolio, which focuses on mid and small cap companies. And more specifically, looking at such companies which are expanding capacity, and post expansion of the capacity, they could see a significant growth, revenue share or market share in the coming years. And then we have our new fund, which we just launched 4-5 months ago, called the Beacon Fund, which is a flexi cap fund. It works brilliantly for an investor who doesn't want to get into this call of how much to allocate in mid cap and how much to allocate in large cap and how much to allocate in small cap. But this is just a one and done kind of a portfolio where an investor gives the money to the portfolio manager, and the portfolio manager then invests and takes that call of allocating to mid, small and large depending on the market opportunity. So it works very beautifully for an investor who's looking at a flexi cap kind of an option. And then we have two thematic schemes. One is our ethical portfolio, which is a principle based investment. And then we have a Dakshin portfolio, which purely focuses on companies that are headquartered in South India. It is a very, very unique theme that we have. So we have a variety of strategies that could fit varying needs of a long-term investor. But as a whole, for a PMS, this is a product or a service, I repeat again, suits an investor who is looking to invest for a longer period of time and who wants to create wealth over a period of time.
Yes, sir. So, what is alternative investment fund, and what are the key trends you see in the alternative investment fund industry in India?
I think AIF is one platform that is now growing significantly. AIF industry now, the alternate investment fund industry as what we call it, has three categories of funds: category 1, category 2 and category 3 funds. Each of them have a specific objective and solve a specific problem. The category 1 fund, typically long gestation funds, they are meant to invest in projects that are infrastructure projects and long gestation projects, and they are typically debt schemes. You have category 2 funds, which are the more commonly known as private equity, venture capital sort of investments. This is both equity, private equity, as well as private debt. And these are by and large unlisted, if I can call it. These are typically funds that provide growth capital and seed capital to businesses that are looking to raise money and that need capital. Then you have a category 3 AIF schemes, which are public market schemes, right? Which invests in listed instruments, be it debt or equity. So there are three categories of alternate investment funds in India. The overall market, as we stand, is close to about 12 lakh crores, which is expected to grow. It's already grown almost 2.5-3 times in the last few years, and is expected to grow almost 3 to 4 times to about 45 lakh crore by 2028. Just to give you a context, our Indian mutual fund AUM is roughly around 68-70 lakh crores, right? So this alternate industry is expected to reach about 45 lakh crore in the next 4 years. So this is one industry that is growing very, very rapidly. Within this, the majority of the AUM obviously right now is in the category 2 schemes, and category 3 schemes is the up and coming right now, roughly about 2 odd lakh crores in category 3 funds which look to invest in public markets. This is something that is also growing very, very aggressively. So overall, the Indian alternate investment fund market is in a sweet spot and could grow at about 4 to 5x from here in the next 4 years.
How do you evaluate the performance of different types of alternative investment funds such as private equity, venture capital, and real estate?
I think, as I mentioned earlier, uh, these are category 2 AIFs predominantly, and these AIFs are meant to provide capital for various kinds of businesses, right? You have a venture fund, right? This is a fund which typically raises money from investors and invests that money and provides that money as capital to startups, right? Who are looking to raise seed fund, right? Very, very early stage funding is what we call it, right? And then you have mid-cycle funds, wherein these are funds which raise money from investors and invest it to companies which are no more looking to get seed funds. They have grown from that stage. Now they are looking at growth capital, right? These are startups, more than startups now. They are looking at a bit more senior level funding, and they are looking at growth capital, right? And these are the mid-cycle sort of fund opportunity, which is also growing now. And then you have late stage funds within the so-called private equity, right? There are 3 odd stages. Then the late stage fund. The late stage fund is typically what the pre-IPOs and what we call it as, what we sort of know it as. These are funds that typically collect money from investors and invest into companies which are now much larger. They are no more startups. They are no more mid market, but now they are much larger. They are very, very well established in the market, and they have a large market share, revenue share, or probably even profitable, right? And now they are looking to go public. And this is a late stage fund where these AIFs come in and invest in these companies. So all of them have very, very different kind of uh, profile of investments, and hence also has very different kind of risk profile. This is in particular to private equity. And then within alternates, you also have real estate, right? And then you also have fixed income plays. Now that is private debt. So you have a real estate fund. Real estate fund very similar to say a venture capital invests these money into real estate projects. It could be a commercial project, which could be rental yielding. It could be a residential project, right? So these work as funnels, which are very critical funnels for developers who need working capital or who need short-term capital or even to extend even long-term capital, which they can't otherwise get from banks or NBFCs. And these AIFs act as very critical funnels for funding those kind of projects also. And real estate has a very different kind of risk as well as return profile compared to say a private equity. So when we call it as alternate is sort of heterogeneous. You have different asset classes, different risk and return profiles.
What are the risks and challenges associated with investing in alternative investment funds?
Risk is ultimately defined by what sort of underlying investments that the alternate makes, right? So you have public market investments, say for a category 3 fund. You may have a long short fund, or you may have a hedge fund, which may possibly have a little lower risk profile compared to say a venture capital fund, right? Um, so it entirely depends on what kind of fund that one is investing into and what kind of return profile one is seeking. But having said that, alternate as a bucket, whether you are investing in a category 2 fund or whether you're investing in a category 3 fund, these are risky instruments. These are not instruments that have carry low risk. These are instruments that are that do carry high risk, and hence they come in the high risk investment bucket of any investor or HNI who's looking to allocate money into alternates.
So how is AIF different from PMS for HNI clients?
Good question, because both alternate and PMS are catered towards high net worth allocation. They both have multiple differences. So I'll outline two key differences. One is the difference in the structure. Portfolio management service, as you are aware, the custody of the shares that are bought, the assets that are bought, lie in the name of the customer. But in alternates, these are NAV based, very similar to a mutual fund analogy I'm taking, comparability. So these are pooled investments where investors get NAV and units allocated, very similar to a mutual fund. So this is one structural difference. The other difference between, say, AIF. When I say AIF, I'm specifically mentioning a public market AIF, since you asked me about PMS, which is also a public market. So I am comparing a category 3 AIF to a PMS. One of the key operating difference could be that of taxation, the way the tax treatment is done. While the same capital gains apply, which applies to a PMS, to a category 3 AIF, but these category 3 AIFs are, the taxation happens at the fund level, right? Unlike, say, a PMS, where since the custody is in the name of the investor, and hence the taxation has to be borne by the investor. At the end of the year, he has to file the taxes and pay those taxes. In the AIF, the taxation is borne at the fund level. So the fund pays the tax, and whatever NAV that is published is post-tax NAV. So at the hands of the investor, the a subscription NAV and the redemption NAV, there is no taxation, any further taxation involved, because the redemption NAV, when an investor goes for a redemption, is already after paying taxes that are incurred by the fund. So this is two critical differences I feel between PMSS and AIF.
Okay, sir. Thank you.
Thank you.